Hello, namaste. Welcome to my another uh, welcome to my channel and on the another episode. So, if you are an Indian HNI, high net worth individuals buying and already owning UK property, you are not sure whether you are fully compliant in both India and UK. This video is for you. I'm C. Abhinarayan Mishra, founder of Cross Border Tax India. And today we cover the complete picture across 10 slides around HEMA, LRS, then ST, SDLT, CGT, IHT, income tax, DTAA, Schedule FA, Black Money Act in India, and a combination of all these with the deadline of 2026, which is calendar year, which is already on. So, the most critical point is Indian tax uh, ROR, that is Indian tax resident and ordinary resident individuals, are taxed on their global income. So UK rental income, UK capital gains, all are taxable in India too. You cannot hide it. India and UK are both OECD CRS automatic exchange mechanism, and UK banks report your data to HMRC, and HMRC in UK shares it with the Indian IT department every year. So non-disclosure means the Black Money Act of 2015 will be applicable, and 30% 30% flat tax rate is there, plus 90% penalty, plus 3 to 10 years imprisonment for undisclosed foreign assets. So no compounding, no amnesty, non-disclosure is essential risk, existential risk to wealth and liberty. Now, if we go further regarding the UK compliance, so if you are owning property in UK, residential property, and you have to pay the stamp duty land tax at a standard rate varying from 2% to 12%. But as a non-UK resident, you pay an extra 2% surcharge. And if you already own another property anywhere in the world, an additional 3% ADS will be chargeable. So, for example, on a £1 million purchase, that totals over roughly over pound 120,000 in SDLT alone. So, file SDLT return within 14 days of completion or face the automatic penalties. So once you have purchased the property and now you are willing to give it on rent. So again, register with HMRC as a non-resident landlord using form NRL1 to receive rent, gross rents. Otherwise, your letting agent will withhold 20% of your income at source. You must still file a UK self-assessment return by 31st January every year. If your property is held in a company structure, then and worth of pound 500,000, annual tax on enveloped dwellings applies, and that will be from pound 4,400 to over pound 30,000 per year. So filed by due date is 30th April annually. If let us say you are remitting, you should be careful that in UK AML is very important. Your UK solicitor will conduct due diligence and uh, at source, and your LRS receipts, IT returns, bank statements, all should be kept handy. The transactions can be blocked if the funds are not satisfactorily explained. And if you own UK property through an overseas company, then you must register with overseas entities of company's house. And failure means up to 5 years imprisonment and unlimited fine. Finally, UK land registry is public, and if your ownership is instantly visible to HMRC, NCA, and Indian Tax Department. When you sell UK property, there is a capital gains tax will apply, and that capital gains tax will be 18% basic rate plus or 24% higher rate at as per to amendment in 2024. So critical rule is capital gains tax must be reported to HMRC online within 60 days and separate from your annual essay return. If you miss it, you will be liable for surcharge. One thing which catches most of the Indian off guard is the inheritance tax. That inheritance tax, UK inheritance tax, is a 40% on UK property above nil rated rate band. And India UK DTAA does not cover that IST. So there is a no or zero treaty benefits will be available. So on a 2 million property, your property could face a pound 600,000 IST bill payable within 6 months of death. So plan early through trust, life insurance, or ownership structuring. Do not leave it if it is till the end, when it is too late. So let us come back to Indian situation, Indian compliance. So you have HEMA, LRS, and residential status. Before remitting fund a single pound, understand LRS. Each Indian resident can remit up to USD 2050 250,000 USD, roughly around 2 crores per financial year for overseas property. So every remittance needs a form A2 with correct purpose code. Full family members limit to fund higher value properties. Remittances above 10 lakh attracts 20% TCS. So you should check section latest amendment in section 206 C1G. It can be claimed as a credit, so against your income tax. And once you own the property, and RBI FLA return is mandatory every year by 15th July. The penalty is INR 2 lakh per day default. If we further we go to the taxing UK property income and gains. So before remitting this for ROR, the UK rental income tax under house property head. So gross annual value minus municipal tax equal to net annual value, and then less 30% standard deduction, less mortgage interest. So full mortgage interest, no INR cap for let out property, and that will be taxable house property at slab rates. So loss can be set off but limited to 2 lakh per annum. Under the capital gains, if it is a property is less than 24 months, so slab rate is up to 30% plus. But if the long term, assuming it will be the long term, so rate will be 12.5% without indexation benefit. If the assets is pre-July 2023, so 20% plus cost with cost inflation index, effective elective option is there. So indexed cost will be INR cost multiplied by TTVR multiplied by CII, that is annually notified by CBDT. And then section 54 exemption is available. You can reinvest the LTCG in one residential house, India or abroad. And Section 54 exemption, EC exemption is there if you purchase bonds and HAI or REC bonds under Section 53 EC within 6 months. Going forward, let us look at the India UK DTA and foreign tax credit. Since both countries tax the same income, the India UK DTA provides some relief through foreign tax credit. So pay your UK tax, file Form 67 here in India before your income ITR. It is a mandatory prerequisite, not optional. So the credit is the lower of UK tax paid or INR tax on the same income. Miss Form 67 and you lose the credit entirely. So genuine double taxation completely can be avoided. Schedule, so this says that, and then you go to the Schedule FA. Schedule FA is very rigorous. Its consequences are very severe. So it is applicable to all ROR individuals holding any foreign asset at any time during financial year. So see properly that in FA you disclose the country code, the nature of asset which is immovable property, and date of UK registration, cost in INR, total remittance at TTBR, and income earned, all UK rental income. So that deadline is ITR due date 30th July or October 31st, depending upon your situation. Why this FA disclosure is important? Because under the Black Money Act, you have to pay 30% flat tax on undisclosed value and additional 90% penalty on same value. So there is no compounding provision is available, and Black Money Act violation cannot be compounded, unlike FEMA violations. And imprisonment is 3 to 10 years for willful non-disclosure of foreign assets, and no amnesty is available. And you must be beware that CRS is auto-reported. UK banks report to HMRC and then HMRC to Indian Tax Department. So Indian Tax Department already know about you more than you know. So PML and the LA, that is money laundering law, and CRS is also, so AD Bank file STR with FIU India IND for suspicious LRS transactions. So they do enhanced KYC, PAN, Aadhaar, IT returns, and source of wealth declaration. India and UK exchange financial account data annually automatically. So UK accounts, rental income, interest, all auto-reported to Indian IT department. So assume 100% visibility of all UK assets. Non-disclosure is indefensible. This is about the Indian situation when you violate this. Now, for the calendar year 2026, you must, before each remittance, you must file Form A2 with AD Bank with the purpose code acquisition of immovable property outside India. Within 14 days of purchase, at UK completion, register with HMRC as non-resident landlord and open UK bank account, appoint letting agent. So within 30 days of purchase, SDLT return filed with HMRC and 2% NR surcharge plus 3% ADS must be included. 30th April, annually 80 ED return plus payment due if property held in a company and with a value of £5,000. In June, July, annually file Form 67 for foreign tax credit on UK taxes paid. So it must precede Indian ITR filing. 15th July is their FLA return to RBI. Disclose UK movable property. Otherwise, penalty is 2 lakh per day for default. 31st January is the UK self-assessment tax return and payment deadline. Rental income, mortgage interest, and all UK income. And 31st July to October or 31st October, you have ITR with Schedule FA, rental income, LTCG declared, and FTA via Form 67 claimed. Within 60 days of UK sale, you must report UK capital gains tax to HMRC online within 60 days of completion. This timeline is strict, deadline is fixed. This is separate from essay return. And within 90 days of repatriation, reinvest or repatriate proceeds as per FEMA Overseas Investment Rules 2022. So this was about the compliance calendar you should follow. So most important, the critical is non-disclosure FA, black activation of black money law. That is the most critical. Disclose always. Penalty of 32% plus 90% plus jail. Then if we categorize the high risk areas, UK's capital gains tax 60-day reporting missed. So report to HMRC online within 60 days of UK sale. Then file 67 before ITR income with HMRC receipts. So UK inheritance tax if you not planned, so 40% UK property, no DTA relief is there. If you have exceeded the LRS limit, so a stagger across years, correct purpose code has to be always mentioned. If FLA report return is not filed in, with RBI, you must file before 15th July. Penalty is 2 lakh per day. Then there are other medium level risk area. So, so action points, 5 action points I have mentioned. The LRS, first is LRS plus Form A2, document every remittance, correct purpose code, full family limits, appoint dual advisors, India CA plus UK tax advisor plus UK AML solicitor before you purchase. Disclose every year plus CRS make non-disclosure catastrophic. Structure the IHT inheritance tax, 40% IST on full UK property value, no DTA relief is available. So plan early. File ITR, file Form 67, ITR first before filing the income tax return in India. So UK property for an HNI can be quite attractive and may give a good return, but only if you get the compliance right in both jurisdictions. So we have just discussed the regulatory landscape in India as well as UK. So this may have helped you understand the broader picture, and if you liked it, please share and subscribe. For any personalized advice, you may reach me at ca.abhimishra@gmail.com or at Cross Border Tax India, and my mobile number is already mentioned there and on the slide. So until next time, file on time, disclose in full, plan ahead. Thank you.